Market reaction to Fed's rate cut. Fed's 50 basis point cut and its implications. The Federal Reserve's decision to lower interest rates by 50 basis points sent ripples through the financial markets, triggering a notable response in multiple sectors. This cut, deemed outsized by analysts, aimed to stimulate economic growth amidst concerns over inflation and a teetering economic landscape. Lowering the interest rate generally makes borrowing cheaper, thereby encouraging spending and investment. As a result, market participants reacted positively, particularly in sectors sensitive to interest rates. The implications of this 50 basis point cut were significant and widespread. It provided a much-needed boost of confidence to investors who welcomed the prospect of enhanced liquidity in the market. Particularly, this decision was portrayed as a vote of confidence from the Fed, with belief that inflation would stabilize around the long-term target of 2%. Impact on bank and growth stocks. Bank stocks experienced a considerable upswing in reaction to the Fed's decision. The SPDR S&P Bank ETF, often referred to as KBE, surged by 2.4%, while the SPDR S&P Regional Banking ETF, or KRE, climbed even higher, jumping 3.3%. Lower interest rates generally benefit banks as they can borrow at lower costs, thus widening their profit margins. The positive momentum among bank stocks signaled investor optimism regarding the viability of financial institutions in a low-rate environment. On the other hand, growth stocks, particularly in the technological sector, were viewed favorably as well. Analysts noted that interest rate cuts favor growth-oriented investments, as they often rely on future profits and can overlook immediate earnings pressures. This dichotomy in market responses suggested that the Fed's move was a boon for both established financial institutions and emerging tech players alike. Sectors that benefited most. Certain sectors gained pronounced advantages in the wake of the Fed's rate cut. The home building sector, driven by expectations of lower mortgage rates, saw the SPDR S&P Homebuilders ETF, known as XHB, reach new record highs. By decreasing borrowing costs, the Fed provided favorable conditions for housing development, which, in turn, fueled investor enthusiasm within this sector. Moreover, the overall stock market displayed significant movements across various asset classes, underscoring the interconnected nature of financial markets. Defensive sectors, typically marked by stability, were discussed as historically more resilient after rate cuts, even as growth sectors thrived. Performance of key stock indexes. In the immediate aftermath of the Fed's announcement, the Dow Jones Industrial Average surged over 100 points, an indicator of robust investor sentiment. This surge reflected an endorsement of the Fed's actions, with traders signaling their readiness to engage in the reactivity showcased across the board. The decisive movement in the Dow also alluded to a growing sense of stability among the investment community, eager to capitalize on perceived opportunities arising from the rate cut. The surge was not merely a statistical anomaly, it represented a convergence of numerous factors, including favorable macroeconomic data and robust corporate earnings reports in preceding weeks. Taken together, these elements painted a hopeful picture for the economic trajectory in the short to medium term. The S&P 500 index also exhibited significant upward momentum, reflecting gains across diverse sectors, notably technology and consumer discretion. The Nasdaq, known for housing technology stocks, displayed similar bullish patterns as growth-oriented companies benefited from the dividend of capital ease. The central bank's reduced interest rate instilled a renewed sense of optimism among tech investors, keen on financing new projects without the heavy burden of steep borrowing costs. Against this backdrop, market participants closely monitored volatility trends, which historically tend to shift in response to Federal Reserve actions. Greater predictability in interest rates amid uncertain economic conditions often leads to a decrease in volatility, a trend the markets played into as optimism spread. Volatility trends are essential indicators of market sentiment. Following the Fed's rate cut, historical patterns suggested volatility might decline, as lower interest rates often lead to enhanced market stability. Traders and analysts were alert to ensuing fluctuations, as the investment landscape evolves based on both market reactions and economic indicators in subsequent weeks. Market watchers remain inquisitive about how long this rally could persist, given the fluctuating macroeconomic factors at play. Continued positive news from economic indicators might indicate a sustained bullish trend, while any signs of inflationary pressures could challenge this growth trajectory. ETF movements and sectoral shifts surge in bank ETFs, KBE and KRE. The heightened activity in bank ETFs, such as KBE and KRE, underscored how institutional and retail investors were almost universally stirred by the rate cut. Their immediate reaction, a robust move upwards, highlights the deep-seated connection between interest rate changes and financial sector valuations. As banks gear up for increased loan activity, the sustained interest in banking ETFs denotes confidence in the resilience of these institutions. This connection has established a pattern where ETFs tracking bank performance are favored whenever the Fed signals a potentially stimulating monetary policy. Homebuilders ETF reaches record high. The Homebuilders ETF, already poised for success, reached unprecedented heights post-rate cut. The interplay of lower mortgage rates and increased buyer activity proved a winning combination, marking a sharp rebound for this sector. Homebuilders were anticipated to flourish under these favorable conditions, resulting in a bullish market outlook for real estate investments. Historical data also supports homebuilders' performance in similar scenarios where rate cuts led to localized surges in residential construction, indicating an established correlation between Fed policies and real estate health. Defensive versus growth stocks post-cut. The contrasting performances of defensive stocks and growth stocks post-cut provided a remarkable study in market psychology, while both categories experienced upticks. Growth stocks generally outpaced their defensive counterparts. This outcome aligns with traditional market behavior following rate cuts, wherein investors redirect their focus to equities poised for escalated earnings growth, welcoming the lower cost of capital. Certain defensive sectors still garnered investor interest, particularly those offering dividends, serving as a hedge against the volatility that might follow. Cryptocurrency stability amid market changes. Bitcoin's resilience following rate cut. Amidst the broader market fluctuations following the Federal Reserve's actions, Bitcoin demonstrated noteworthy stability. Trading at around $60,205.76, it remained largely unaffected by immediate market volatility. This resilience is indicative of a growing acceptance of Bitcoin as a legitimate asset class that can weather macroeconomic fluctuations, adapting to developments in traditional markets. The juxtaposition of crypto and equity markets showcases the evolving dynamics of investor behavior, underlining the diversification of portfolios in light of new financial realities. Forecasts for crypto market trends. The overarching sentiment within the cryptocurrency market suggested an optimistic outlook. Analysts speculate that as traditional financial systems navigate interest rate changes, cryptocurrencies could consolidate their positions as alternatives for asset allocation. Market analysts anticipate that crypto assets, driven by institutional adoption and growing mainstream acceptance, might see continued appreciation if macroeconomic conditions permit. In particular, observations regarding increasing Bitcoin adoption could catalyze upward trends in valuations over the coming months. Impact of Fed decisions on cryptos. Federal Reserve policy holds substantial sway over the cryptocurrency realm. Interest rate changes inform the broader economic environment, ultimately influencing investor confidence in speculative assets like Bitcoin. Consequently, as the Fed navigates its monetary policy, subsequent shifts in crypto market performance can be closely monitored and correlated to these decisions, underscoring the importance of these broader economic indicators. FAQs. What factors contributed to the Dow's increase following the Fed's decision? The Dow's increase can be attributed to the positive investor sentiment surrounding the Federal Reserve's rate cut, increased liquidity, and optimistically viewed macroeconomic data. The decision fostered a sense of confidence, particularly among growth and bank stocks. How does a 50 basis point cut impact the stock market? A 50 basis point cut typically lowers the cost of borrowing, encourages spending and investment, boosts consumer confidence, and generally stimulates economic activity. As a result, stock markets often respond positively, reflecting investor optimism. What historical significance does this record high have for the Dow? This record high underscores the critical intertwining of monetary policy and market performance. Historically, similar Fed rate cuts have often coincided with bullish trends in the stock market, establishing a reinforcing pattern of investor behavior. What are analysts predicting for the stock market after this rate cut? Analysts project that the stock market could experience sustained growth in the near term, contingent upon forthcoming economic indicators and corporate earnings reports. The potential for increased investment across multiple sectors remains a focal point of interest for market participants looking ahead.